Imagine Sarah, a dedicated teacher, finally gets the raise she's worked so hard for. A significant bump that could mean a new car, or finally tackling those home repairs. But then, a whisper starts in her mind: what if this raise pushes me into a higher tax bracket, and I actually end up with less money overall? This isn't just Sarah's fear, it's a common worry for millions of people across the country. This widespread misunderstanding about tax brackets causes real anxiety and sometimes even makes people hesitant to pursue career growth or salary increases. It's time we truly understood what's happening. The myth is simple, yet incredibly powerful. If your income crosses into a new tax bracket, all your income will be taxed at that higher rate, leading you to bring home less money than before the raise. This idea is so pervasive that it stops people from celebrating their achievements. It creates a ceiling, a psychological barrier that can hold individuals back from reaching their full earning potential. But here's the crucial spoiler: this is absolutely, unequivocally, false. Nobody explains it quite this way, but understanding this one point can change your entire financial outlook. Let's break down why. So, if it's false, why do so many people believe it? Part of the problem is the language. Tax bracket sounds like a solid wall, a cliff you fall off. The terminology itself conjures images of an all-or-nothing scenario. Another factor is the complexity of the tax system. Let's be honest, taxes aren't taught in school, and the jargon can feel overwhelming. Without a clear explanation, it's easy to fill in the gaps with scary assumptions. Today, we're going to dismantle those assumptions, replacing fear with clarity, one simple step at a time, just like we're climbing a gentle slope, not a sheer cliff. Before we go any further, let's define our terms. What exactly is a tax bracket? In essence, it's a range of income that is taxed at a specific rate. Think of it like a series of progressive steps. The U.S. federal income tax system is a progressive system, meaning that as your income increases, higher portions of that income are taxed at higher rates. It's not a single rate applied to everything you earn, but rather different rates applied to different portions of your income. This distinction is absolutely critical to understanding how it all works. Let's use an analogy to make this crystal clear. Imagine your income as water flowing into a series of buckets, or rather, a staircase where each step has a different tax rate attached to it. The first step, the lowest bracket, might be taxed at 10%. The next step, for the next portion of your income, might be 12%, and so on. Your money doesn't all jump to the highest step you reach. Instead, it fills up each step in order, with only the money in that specific step being taxed at its corresponding rate. This is the heart of the progressive system. This brings us to two incredibly important concepts: the marginal tax rate and the effective tax rate. Your marginal tax rate is the rate at which your last dollar of income is taxed. It's the highest bracket you reach. Your effective tax rate, however, is the total amount of tax you pay divided by your total taxable income. It's your average tax rate. The marginal rate is what people incorrectly assume applies to all their money, while the effective rate tells the true story of how much tax you actually paid. We'll illustrate this with simple numbers. Let's revisit Sarah, our teacher. For simplicity, let's say the first tax bracket is 10% for income up to $10,000, and the second bracket is 12% for income between $10,001 and $40,000. If Sarah earns $10,000, only that $10,000 is taxed at 10%, meaning she pays $1,000 in taxes. Her marginal rate is 10%, and her effective rate is also 10%. Simple enough. She's only in the first bucket, and that bucket is full. Now, let's introduce Mark, a freelance designer. He has a great year and earns $20,000. Using our simplified brackets, the first $10,000 of his income is still taxed at 10%. That's $1,000. The next $10,000, from $10,001 to $20,000, falls into the 12% bracket. So, that specific portion is taxed at 12%, which is $1,200. His total tax liability is $1,000 plus $1,200 equals $2,200. Mark's marginal rate is 12%, but his effective rate is $2,200 divided by $20,000, which is 11%. See? Not all his money was taxed at 12%. This is the core insight nobody emphasizes enough. When you jump into a higher tax bracket, only the portion of your income that falls into that new, higher bracket is taxed at the higher rate. Every dollar you earned below that bracket is still taxed at the lower rates. It's like adding more water to an existing series of buckets. The water in the first bucket stays at its level, the water in the second bucket stays at its level, and only the overflow goes into the next, higher-priced bucket. You are always better off earning more money. So, Sarah's fear, and the fear of millions, is unfounded. Earning more money will never result in you taking home less money overall. You will always have more discretionary income. Your tax bill might go up, absolutely, because you earned more money. But the percentage of that additional income that you get to keep is still substantial. The progressive system is designed to tax higher earners more, but not to penalize anyone for earning more. This understanding alone can be incredibly liberating, removing a huge mental block for many. Now that we've cleared up the biggest myth, let's dive a little deeper. The tax brackets we've been discussing apply to your taxable income, not your gross income. What's the difference? Your gross income is the total amount you earn before any deductions. Your taxable income is the amount that's left after certain allowable deductions and exemptions have been subtracted. This is a crucial distinction, because it means you might earn a significant amount, but your taxable income could be much lower, potentially keeping more of your income in lower tax brackets. This is where strategic planning comes in. Deductions are expenses that you can subtract from your gross income, effectively lowering the amount of income that the government can tax. Think of them as ways to reduce the size of the water flow before it even hits the tax rate buckets. There are two main types of deductions for individuals: the standard deduction and itemized deductions. Most people take the standard deduction because it's simpler and often larger than what they could itemize. But understanding both is key to minimizing your tax burden. The standard deduction is a fixed dollar amount that nearly every taxpayer can subtract from their gross income. It's the simplest way to reduce your taxable income, and it's a fixed amount determined by your filing status: single, married, filing jointly, head of household, etc. For many, especially those without a lot of specific tax-deductible expenses, taking the standard deduction is the best and easiest option. It automatically lowers your taxable income, potentially keeping more of your earnings in those lower tax brackets without needing complicated calculations. Itemized deductions, on the other hand, are specific expenses you can subtract, such as mortgage interest, state and local taxes, medical expenses above a certain percentage of income, and charitable contributions. You would only choose to itemize if the total sum of your eligible itemized deductions is greater than the standard deduction amount for your filing status. This requires more record keeping and calculating, but for some, it can lead to a significantly lower taxable income. It's about finding which option provides you with the biggest tax break. Let's consider Maria, a recent homeowner. Her gross income is $60,000. The standard deduction for a single filer might be around $13,850. But Maria paid $10,000 in mortgage interest, $5,000 in state and local taxes, and donated $2,000 to charity. Her itemized deductions total $17,000. Since $17,000 is greater than $13,850, Maria would choose to itemize. Her taxable income drops by $17,000, not $13,850, meaning a larger portion of her income is effectively untaxed, or taxed at lower rates. This small decision can make a big difference in her tax bill and her take-home pay. Beyond deductions, there's another powerful tool: tax credits. If deductions reduce your taxable income, credits directly reduce the amount of tax you owe, dollar for dollar. A $1,000 deduction means $1,000 less income is subject to tax. A $1,000 credit means you pay $1,000 less in taxes, regardless of your tax bracket. This is why credits are often considered even more valuable than deductions. They are direct cash savings. Common credits include the child tax credit, the earned income tax credit, and education credits, among others. Let's highlight the difference between a deduction and a credit. If you're in the 22% tax bracket, a $1,000 deduction saves you $220 in taxes, $1,000 * 22%. It reduces the income that is exposed to that tax rate. But a $1,000 tax credit reduces your tax bill by a full $1,000. It doesn't matter what your tax bracket is. This direct reduction makes credits incredibly impactful, especially for lower and middle income families, or those with specific qualifying expenses like college tuition or childcare. Understanding this distinction is vital for tax planning. One more important term, adjusted gross income, or AGI. Your AGI is your gross income minus certain above-the-line deductions, like contributions to a traditional IRA or student loan interest. AGI is a critical number because many other deductions, credits, and even your eligibility for certain programs are based on it. For example, the amount of some itemized deductions you can take, or whether you qualify for specific tax credits, often phases out as your AGI rises. Keeping your AGI as low as legally possible is a smart strategy for many, as it opens doors to more tax benefits. Let's recap the journey of your money through the tax system. First, you earn your gross income. Then, you subtract above-the-line deductions to get your adjusted gross income, AGI. From your AGI, you subtract either the standard deduction or itemized deductions to arrive at your taxable income. It's this taxable income that gets divided up and taxed across the different tax brackets. Finally, once your total tax liability is calculated, you subtract any tax credits you qualify for to find your final tax bill. It's a structured process designed to be fair, not punitive. Most people don't pay their taxes in one lump sum at the end of the year. Instead, money is withheld from each paycheck throughout the year. This is called tax withholding, and it's an estimate of what you'll owe based on the W-4 form you fill out for your employer. The goal is for your total withholdings to be as close as possible to your actual tax liability. Too much withheld? You get a refund. Too little? You owe more. It's a pay-as-you-go system designed to prevent a huge tax bill at once. Come tax season, usually around April 15th, you file your tax return. This is where you report all your income, deductions, and credits. The IRS, Internal Revenue Service, then calculates your actual tax liability. If your total withholdings throughout the year were more than your actual tax liability, you get a tax refund. If they were less, you owe the difference. It's a yearly reconciliation, a balancing act to make sure you've paid the correct amount of tax for your income and circumstances. A refund isn't free money, it's your own money that the government held for you. While income from wages is taxed at ordinary income tax rates, income from investments, like selling stocks or real estate, often falls under capital gains. These are typically taxed at different, often lower, rates than your regular income. Short-term capital gains, assets held for a year or less, are taxed at your ordinary income tax rates, aligning with your current tax brackets. Long-term capital gains, assets held for more than a year, have their own, generally more favorable, separate tax brackets. This is why investing for the long term can be a smart tax strategy. If you're self-employed, like our designer Mark, things get a bit more complex. Beyond income tax, you're also responsible for self-employment tax, which covers Social Security and Medicare contributions. When you're an employee, your employer pays half of these taxes, and you pay the other half. As a self-employed individual, you're both the employer and the employee, so you pay both halves. This is generally 15.3% on your net earnings. However, there's a deduction for half of your self-employment taxes, which lowers your taxable income. It's an important consideration for freelancers. Understanding tax brackets and deductions becomes even more critical when you start a business. Small business owners can deduct a wide array of business expenses, from office supplies and equipment to home office expenses and health insurance premiums. These deductions directly reduce their net business income, which is what ultimately flows through to their personal tax return and interacts with the tax brackets. Without this knowledge, many would-be entrepreneurs might overpay or, worse, feel daunted by the financial implications, preventing them from pursuing their dreams. Getting married often means a significant change to your tax situation. Your filing status changes to married filing jointly or separately. For many couples, especially those with similar incomes, combining incomes can push more of their joint income into higher tax brackets, sometimes referred to as the marriage penalty. However, for couples where one spouse earns significantly less, combining incomes might lead to a marriage bonus. It's not a universal penalty or bonus, but a nuanced interaction with the progressive bracket system, making tax planning crucial after tying the knot. Understanding how tax brackets, deductions, and credits work isn't just academic, it's an empowering tool for financial planning. It allows you to make informed decisions about your career, your investments, and your life. Should you contribute more to your 401k or IRA? That reduces your taxable income, potentially keeping you in a lower bracket. Should you itemize or take the standard deduction? This knowledge helps you optimize your tax situation, leading to more money in your pocket and less anxiety during tax season. You're not just a passive recipient of the tax system, you can actively manage your relationship with it. Despite all this information, people still make mistakes. The biggest, of course, is believing the lose money from a raise myth, which can lead to missed opportunities. Another common error is failing to adjust W-4 withholdings after major life changes like marriage, having a child, or getting a new job. This can lead to a huge tax bill or an unnecessarily large refund, which means you're giving the government an interest-free loan. Finally, not keeping good records for deductions and credits is a frequent oversight, costing people valuable tax savings. It's simple organizational habits that can save you real money. Let's revisit Sarah and her raise one last time. If her salary increase pushes her income into a higher bracket, say from 12% to 22%, it means that only the new portion of her income above the 12% bracket threshold will be taxed at 22%. The money she was already earning will still be taxed at 10% and 12%, respectively. There's no magical point where all her income retroactively gets taxed at the highest rate. This jump isn't a cliff, it's just another step up on the ladder, where only the newest rung is at a higher price. She's unequivocally bringing home more money. The biggest takeaway here is the power of knowledge. Taxes might seem intimidating, but by understanding basic concepts like marginal rates, taxable income, deductions, and credits, you can transform your relationship with your finances. No longer will the tax system feel like a mysterious force working against you. Instead, you'll see it as a structured system with rules you can learn and use to your advantage. This understanding reduces financial stress, empowers better decision-making, and allows you to confidently pursue financial growth without fear of unexpected penalties. So, what can you do with this newfound understanding? First, review your W-4 form, especially if you've had life changes. Make sure your withholdings accurately reflect your situation. Second, start tracking potential deductions and credits throughout the year. Keep good records for things like charitable donations, medical expenses, or business costs. Third, consider consulting a tax professional or using reliable tax software. They can help you identify opportunities and ensure you're taking advantage of every benefit you're entitled to. Finally, keep learning. The more you know, the more confident you'll be. Ultimately, this video is about empowering you. The tax system is complex, but it's not designed to trick you or punish you for success. It's a system with rules, and once you understand those rules, you gain a significant amount of control over your financial life. You can chase that raise, start that business, or invest for the future with confidence, knowing that you understand how your income will be taxed. The higher tax bracket fear is a myth that needs to be permanently retired. Go out there and earn all you can, without the worry. We hope this deep dive has demystified tax brackets for you. If you found this explanation helpful, please hit that like button, share it with someone who needs to hear it, and subscribe to our channel for more plain language financial education. Understanding taxes is a fundamental part of financial literacy, and together, we can build a more informed and less anxious community around money. Thank you for watching, and remember, knowledge is truly power when it comes to your money.